Welcome back. Earlier today, the U.S. Bureau of Labor Statistics reported for the month of December 2022, year-over-year inflation fell to 6.5% from the 7.1% number reported in November. This represents the smallest 12-month increase since the period ended October 21. Core CPI, excluding food and fuel, rose 5.7% over the last 12 months compared to a 6% number in November. Month-over-month consumer prices fell 0.1%. This is the first decline on a month-over-month basis since May of 2020. So we definitely are seeing some weakening in the CPI, which is a primary inflation report. And this goes to traders' minds and investors' minds in terms of the Federal Reserve's next move. And it certainly does give credence to the fact that the Federal Reserve might be close to the end of their interest rate tightening cycle, and the markets are responding accordingly. Taking a look at the number today, 298.112, this represents a decline from the prior month, and not the lowest low, certainly we've seen over the past 12 months or so, but it is the first significant decline, decline overall we've seen in quite a while. Taking a look at the statistics, we can see this is the first actually decline on a month-over-month basis, negative 0.08% to the downside. Now, taking a look at the bond market, we can see that the 1 and 2 year bonds, the yields are slightly to the downside. Traders are putting a little bit of money into those, and we see major declines on the longer-term maturities. The 3 and 5 year bonds are down about 0.04%, around 4 basis points. And the longer term maturities are down even more than that. So we see capital is moving into the longer term maturities, at least for today. Because again, as the yields go down, it means that the price of the bonds are actually going up. Traders have a little bit more confidence in the longer term maturities, which is really the opposite of what we've seen for quite a while now. Taking a look at the top right-hand side, the blue line represents the S&P 500, which has been quite strong as of late. The red line represents total bond yield. So if we were to add up all the different yields, we have the 1 month yield pays a 4.42%, the 2 month 4.62%, all the way up. We add all those together, and we see that the total bond yields come out to about 50.9, about almost 51 percentage points across all the different maturities added up together. The reason why this is important is because we can see quite a positive correlation. As a red line moves up, that's a total yield, the S&P 500 has also moved up. Now we do see some weakness on the S&P 500 during the latter part of last year, ultimately hitting lows around December, the end of December. But so far in the beginning of 2023, we've seen a strong stock market, which coincides with the anticipation, I believe, of the end of the interest rate tightening cycle, and we see a double top on the yields overall. Notice over here the 10 1-year spread, meaning the difference between the 1 year and 10 year bonds, those maturities, is a negative 1.23%. In other words, the 1 year bond pays a 4.84. The 10-year bond pays a 3.61. So we still see quite a significant inverted yield. Maybe not the biggest inversion we've seen, but definitely a very significant inversion, where traders are selling aggressively the short-term bonds. We know this because those yields, for example, on the 1 year and 6 month are a lot higher than the 10-year. The traders basically have very little confidence in the near-term future. Now, the stock market's moving up maybe in anticipation of lower interest rates down the road. There seems to be a little bit of a disconnect, but the bond market reflects more purely the economic expectations, and that, at least in terms of the inversion in the bond market, still does not look very optimistic. Top left-hand corner, we see every single dot represents one stock in the S&P 500. Each measured on a scale of 0 to 100 in terms of their own respective RSI, relative strength indications. We can see the majority of the stocks have an RSI, a relative strength index, between 45 to 65. On the top right-hand side, we see the histogram chart, which really gives us a breakdown as far as the frequency, the number of stocks. For example, we have 104 stocks in the S&P 500 that have an RSI between 60 and 65. We have another 103 stocks with an RSI between 65 and 70. So there's a good amount of stocks that are trading above the 50 level. In fact, most of the S&P 500 has a relative strength above 50. But we take a look at the green charts below, it shows us the same thing, but this time in terms of their own respective 52-week ranges. And we can see a very equal distribution of the stock markets and the S&P 500 to be specific, as far as within their own respective 52-week ranges. The histogram bars on the bottom right-hand side show us the same thing. So the difference is this. The RSI in the top yellow chart shows us the relative strength, which is a more reactive, more immediate chart. But the bottom green charts show us these stocks in terms of their own 52-week ranges. So the way to summarize this is that the recent stock market strength has pushed the RSIs up quite a bit. But the actual stock market is actually right in the middle of its overall range. We see just as many stocks within the 30 percentile of their 52-week range as we see stocks within the 80 percentile. Point being is that the market and these charts have reacted to recent stock market strength, but we're very, very far away from seeing a very strong bull market. What we see is a market that's really spread out across many different sectors. Speaking of the sectors, we see exactly this. This is the relative strength of each individual sector that's found in the S&P 500. And we can see that there's a very equal distribution. Most of the different sectors, from the strongest, which includes NASDAQ telecommunications, gold and silver index, transportation, etc., those have a very strong RSI, but it's very close to the weaker sectors, which include at the very bottom the 10-year Treasury index, the market volatility index, that's the VIX. But if you take away the Treasury indices and the volatility indices, which are considered to be hedges against falling stocks, the rest of the market spread out very, very evenly, at least in terms of the relative strength. In terms of their own 52-week ranges, there's a more clear division. Those sectors that are very close to their 52-week highs include oil services, biotech, energy, select Spider Trust, industrials, Dow Jones Industrials. The weaker sectors are very close to the lows of the 52-week ranges. That includes the NASDAQ Components Index, the CBOE Volatility Index, again, that's the VIX, consumer discretionary, NASDAQ utilities and banks as well. So I really suppose the way to accurately sum this up is that the CPI looks like it's beginning to weaken, which will lead traders and investors to believe that the Federal Reserve is near the end of their tightening cycle. And as a result, we see certain stocks that I believe are more sensitive to interest rates. Those could bode well, or already have gone up quite a bit. But the strongest sectors are very, very particular, includes oil services, biotech, energy, things of that nature. The rest of the market is spread out pretty equidistantly across different sectors, at least in terms of their RSI. But in terms of the 52-week ranges, it's more of a stock picker's market. Going back to the bond market, we still have a very significant inverted bond market. And this is not exactly a predictor of an ultimate recession, but every major market turnaround and pullback, I should say, has been preceded by an inverted bond market, which is still very, very much out there, and it doesn't look like it's going to change, at least in the near-term future. We hope this has been helpful. We look forward to seeing you back soon.